You are staring at your investment portfolio on this December 26, 2026. Silver just closed the Christmas holiday at $71.94 per ounce. That represents a staggering 149% gain for the year. Your hands might be shaking right now, and not because of what has already happened, but because of the massive shift that is about to occur. Because right now, at this exact second, every major market maker, every institutional trading desk, and every liquidity provider who keeps the silver market functioning has walked away from their terminals. They are on vacation. They will not be back until January 6th. That leaves 10 full trading days where the fifth largest commodity futures market in the world is operating on skeleton crews and automated systems. Sitting right there in the middle of this liquidity blackout are 145,000 open futures contracts. These contracts represent 725 million ounces of physical silver, worth $52 billion. This is the Ghost Week liquidity trap, and for many investors, it has already sprung. I have spent the last 8 years analyzing commodity market microstructure, which is just a fancy way of saying I study what happens when there are not enough buyers to match the sellers. What we are witnessing right now is the most dangerous market setup since nickel went vertical on the London Metal Exchange in 2022 and bankrupted a $7 billion trading firm in just 48 hours. If you are currently trading silver, holding silver mining stocks, or simply trying to figure out if $72 is the top or just the beginning, you need to listen closely. The mechanics being broken down right now will determine whether you capture the next leg up or get destroyed by volatility you did not see coming. Here is what everyone else is talking about today. They are saying silver is overbought. They are pointing to the Relative Strength Index, or RSI. They are citing historical resistance levels and calling this a bubble because it moved too fast. However, all of that analysis is built on one fundamental flaw. It assumes that markets behave normally when liquidity is normal. That is the trap. We are no longer in a normal market. We are in a structural deficit market, operating under ghost conditions, with institutional positioning that is more lopsided than at 8 point in the last decade. Trading volume in precious metals typically drops 70% or more during the week between Christmas and New Year's. That is not speculation. It is historical data from the CME Group going back 20 years. But here is what makes 2026 different. The open interest, meaning the total number of contracts that have not been closed or delivered, has not dropped. The March 2026 contracts, known by the ticker symbol SIH26, are sitting at record elevated levels. Industrial buyers who normally would have closed their positions before the holidays simply could not. The physical market is so tight right now that closing a futures position means finding actual metal to buy. And there simply is not enough available at current prices. So instead, these positions are frozen in limbo, while the people who normally provide the other side of those trades are ignoring their phones and eating holiday leftovers. Let us look at what is happening underneath the surface. Silver has been in a supply deficit for 7 consecutive years. Not quarters, not months, but 7 full years. The Silver Institute documented a cumulative shortfall of 678 million ounces since 2018. 2024 alone showed a deficit of nearly 149 million ounces. Global mine production has been essentially flat at 813 million ounces for the last 5 years. Meanwhile, industrial demand has hit 680 million ounces and continues to climb. This is not a temporary imbalance. It is a structural break in the supply chain that cannot be fixed quickly. Silver mines take an average of 6.5 years to go from discovery to production. according to S&P Global Market Intelligence. It gets even more dangerous when you look at solar panel manufacturing. The industry is consuming over 200 million ounces of silver annually right now. The technology shift happening in solar is making the problem exponentially worse. The industry is moving from old technology to what is called TOPCon cells. These cells are more efficient for energy, but they are catastrophic for silver supply because TOPCon cells require 50% more silver per panel. The International Energy Agency projects that solar alone will consume 450 million ounces annually by 2030. That is more than half of current global production being absorbed by a single industrial application. This industry cannot substitute silver because its unique electrical conductivity and reflectivity are what make the technology work. Then you have to add the automotive sector. Every electric vehicle uses between 1 and 2 ounces of silver, depending on the model. Global electric vehicle production hit 14 million units recently, adding another 28 million ounces of inelastic demand. The USGS designated silver a critical mineral in 2025 because it is strategically important and supply is concentrated in politically unstable regions. This matters because it means silver is no longer just a precious metal. It is a critical industrial commodity. This creates the exact conditions for violent price discovery when liquidity disappears during this ghost week. Before the holiday break, the CFTC reports showed commercial traders, which are the big banks, holding their largest net short position in 18 months. They were short because they had been selling to hedge industrial demand. Under normal conditions, they would manage those positions throughout the day. But these are not normal conditions. The systems left in place are automated. Automated systems do not adjust to changing fundamentals. They only execute based on predetermined rules. Since December 26th, industrial buyers who needed to lock in silver for first quarter production could not execute their normal spot market purchases. Physical premiums have gone completely unhinged, reaching 12 to 18% over the spot price in some markets. A normal premium is 2 to 4%. So instead of buying physical metal, they are being forced into the futures markets to secure their supply. But the futures markets during this week do not have the depth to absorb large orders without moving the price significantly. Every large industrial buy order is hitting thin order books and pushing the price up 3, 4, or 5% in minutes. Every time the price jumps, it triggers stop losses on the short positions managed by algorithms. Those algorithms then cover their positions by buying, which pushes the price even higher. It was not about demand or supply. It was a liquidity vacuum meeting forced covering. With silver, there is no circuit breaker wide enough to stop this. The CME has limits, but silver already moved $4 in just 3 sessions last week. We are already halfway to a limit-up move, and the real pressure has not even started yet. UBS recently warned clients that precious metals price action has become unhinged, and volatility metrics are signaling unstable conditions. Even conservative analysts like Kitco Metals published a $75 price target for this quarter, based purely on momentum. When liquidity returns, every deferred industrial purchase and every margin call will hit the markets simultaneously. When you remove liquidity and freeze positions, the pressure builds until it is released violently. Some might ask why this cannot resolve to the downside. Normally, when a commodity gets too expensive, producers increase supply and consumers reduce demand. None of those mechanisms work for silver right now. Producers cannot increase supply because there are no large silver-only mines ready to come online. Most silver is mined as a byproduct of copper, lead, and zinc. You cannot just dig more silver without copper prices justifying expanded operations, and even then, it takes years. Consumers cannot reduce demand either, because they are locked in. Solar manufacturers cannot reduce silver content without losing efficiency and losing their contracts. Automotive manufacturers cannot eliminate silver without redesigning entire platforms, which takes billions of dollars and years of development. Industrial demand is now what economists call perfectly inelastic. Price does not reduce consumption because consumption is not optional. There is no material that matches silver's properties at any price point below where we are now. So you have inelastic demand, fixed supply, and no substitutes meeting a liquidity crisis. In thin markets, the next buyer might be willing to pay 5% more than the last trade just to keep their production lines running. Once that trade happens, it becomes the new reference price, and the algorithms adjust. Suddenly, 72 becomes 75, which becomes 80. When markets reopen with full participation on January 6th, the first thing institutions will do is test if these ghost week prices are real. If the market does not have sellers at those levels, and it likely won't because physical holders are raising their offers, institutions only have two choices. They can wait, or they can chase. Industrial buyers cannot wait. They have contractual obligations and production schedules. They have to chase the price. This is where the psychology shifts from investment to absolute panic. When the price gaps 10% in a day, investment buyers might pause, but industrial buyers buy regardless of the price. Their buying creates a visual on the charts that looks like mania, which attracts momentum traders and forces out more shorts. It is a perfectly constructed trap, where every normal mechanism to prevent runaway prices has been disabled. The silver market is currently operating in the same regime that oil was in during the 2008 spike. Back then, futures markets disconnected from physical markets, because the paper market assumed supply could grow, and the physical market knew it could not. Oil went from $90 to $147 in 6 months. Silver is starting from a higher relative valuation, has a smaller market, and has deeper structural deficits. I am not saying silver goes to $150 by next Tuesday, but the conditions exist for it to gap in ways that seem impossible until they happen. The market is not pricing in these ghost mechanics or the solar demand bomb. If you have understood this far, you are already ahead of 90% of the people watching this market. But you must know how to position yourself without getting destroyed by the volatility. First, understand that during Ghost Week, normal technical analysis does not work. Support and resistance levels are meaningless when there is no depth. Your entire framework must shift from predicting price to managing your position. If you are long, you must think about what happens when the price gaps $5 in your favor and then reverses $3 at the open because of profit-taking in thin liquidity. Second, the March 2026 contract is where the pressure is concentrated. That is where the industrial buyers and the commercial shorts are stuck. When that contract moves, it will move harder than the spot price because of leverage. Third, physical premiums are telling you something the futures prices are not. When you see 18% premiums on bars, that is real buyers paying real money because they value possession over paper promises. Physical markets lead futures markets in tight supply situations every single time. If premiums are rising while futures are consolidating, the futures are mispriced and they will catch up in gaps. Fourth, mining stocks are not the same as metal. They are operational businesses with costs and political risks. If the price spike is too fast, it can trigger concerns about windfall taxes or nationalization in some regions. You need to know which companies have locked in their costs and which ones are exposed to political risk. Finally, the timeline is more important than the target price. I cannot tell you if the top is $85 or $120, but I can tell you that Ghost Week ends on January 6th. Industrial purchasing accelerates in January. Solar manufacturing ramps up in February. All of that demand hits the market in a small window starting right now. If this squeeze happens, it happens in the first quarter of 2026. The real shift happens when you realize this is not about whether silver goes up. It is about whether you are prepared for a market that no longer behaves predictably. Most people trade commodities like stocks, trusting that liquidity will always be there. But when the physical market gets tight enough, the paper market breaks. Positions get liquidated at prices that do not make sense, and exchanges change rules overnight. The hard truth is that if you are trading based on chart patterns right now, you are bringing a knife to a gunfight. The manufacturers and central banks are not looking at your charts. They are looking at production schedules. When their systems say they need metal by February 15th, or a production line stops, they will buy at any price. That is what inelastic demand looks like in practice. You have 7 years of deficits, massive solar demand, and frozen mine production. You have Ghost Week liquidity removing the market makers, and commercial shorts stuck in positions they cannot manage. You have 145,000 contracts, representing $52 billion, waiting for January 6th. This is a powder keg, and the fuse is already lit. You are no longer guessing if silver is expensive. You are calculating if the market structure can support a violent repricing. This is a transition from a precious metal to a strategic industrial commodity. That transition happens in violent jumps. Markets do not gradually acknowledge their math was wrong. They gap and they lock limit. Everything you need to know is available in the data, from supply deficits to solar projections. The only question is whether you are willing to act on information that feels uncomfortable because the price has already moved. The people who succeed are those who understand the market structure better than the market prices it. Either the price stays here and production lines stop, or the price gaps until supply appears. Since supply cannot appear for years, the price must keep moving. Your job is to figure out who blinks first: the industrial buyer who needs the metal to survive, or the futures trader who is over-leveraged and terrified. The industrial buyer has a schedule and a contract. The trader has a margin call. The industrial buyer will hold longer every time. That is the game, and it starts tomorrow when the markets open and liquidity is 70% thinner than normal. The squeeze does not start when everyone is watching. It starts when nobody is paying attention, and by the time the news catches up, the move is already over. Protect your legacy and stay focused on the mechanics.